Everyone knows the VIX, right? The fear index. It's supposed to tell us how volatile the market expects to be. When it spikes, buckle up. When it's low, cruise control. Simple. Except, the market is rarely simple, and the VIX often feels like it's telling you yesterday's news, reacting rather than predicting. Take today, the VIX is down 2.65%, seemingly calm. Yet, the Nasdaq just dropped 1.73%, and gold surged over 2%. These aren't minor jitters, they're significant shifts. Traditional models struggle to connect these disparate movements in real time, leaving traders scrambling to understand the true underlying risk. They're trying to predict the future with a rear-view mirror. The core problem? Market expectations, like those embedded in options prices, form complex smiles or smirks when plotted. When the market shifts, these intricate smiles change shape. Recalibrating these curves for both the S&P 500 and the VIX, simultaneously, is a computational nightmare. It's like trying to rebuild a skyscraper every time a single window breaks, taking far too long to react effectively. Enter optimal transport. Imagine you have two piles of sand, representing market expectations before and after a shock. Optimal transport is the mathematical equivalent of finding the most efficient way to move the first pile to become the second. It maps how one market state transforms into another, minimizing the cost or effort. It's a powerful way to understand market shifts. But even optimal transport is too slow if you have to solve the entire complex problem from scratch every time the market twitches. This new research introduces a perturbation methodology. Instead of rebuilding the entire sand castle, they figure out how a small nudge to the market changes the existing optimal transport plan. It's like calculating the precise ripple effect without throwing a new stone, offering incredible speed. Crucially, they don't just look at SPX or VIX in isolation. They jointly calibrate their market smiles, understanding their intricate dance. Then, using something called skew stickiness ratio dynamics, they translate an S&P 500 shock directly into how the VIX's future expectations will warp. It's a direct, fast line from stock market jitters to precise fear index shifts, capturing their true relationship. The result? Risk estimates that are computationally much faster and produce accurate risk estimates relative to full recalibration. This isn't just academic theory. For quants and traders, it means significantly better, faster hedging strategies, especially when markets like the Nasdaq or gold are making sudden, volatile moves. It's a serious competitive edge in a fast-moving world. So, the next time the VIX seems to be lagging, remember, there are quants out there using advanced mathematics to decode its true language. They're predicting market shocks with a speed and accuracy that leaves traditional models in the dust. The market isn't just a casino, it's a supercomputer trying to predict itself, and these models are its cutting-edge algorithms.